Hindenburg Research closed shop, and SuperMicro has submitted its delayed 10K and also its 10Qs. But despite that, the stock remains heavily shorted. So what is really going on? Let's break down the latest developments and, more importantly, what is ahead for the company. When SuperMicro provided updated guidance in its earnings call, it was below expectations. They have guided for Q3 revenue of between $5 and $6 billion, while the consensus was $5.9 billion, and a Q3 EPS of between 46 and 62 cents, while the consensus was 65 cents. For Q4, if we take the midpoint of their Q3 guidance, then their revenue should come in between $6.38 billion and $7.88 billion. But I think that we should look at the bigger picture here. They have more than doubled their revenue from $7 billion to almost $15 billion from 23 to 24. And they are now looking for 2025 revenue of between $23.5 billion and $25 billion, which is down from the $30 billion they have originally projected. However, Charles Liang said that the company should reach a revenue of $40 billion plus in fiscal year 2026. He also said that this is a very conservative estimation. So basically, they should be able to grow their revenue by at least 60% plus. Before the call, the consensus for 2026 revenue was only $29 billion. He then also mentioned that the company should keep up this revenue growth of 60% plus beyond 2026. This would take SuperMicro to a fiscal year 2027 revenue of $64 billion plus. If SuperMicro can achieve this level of revenue growth, that would be impressive. It was easier to do this while they had a lower base. But if they could keep up a 60% year-over-year growth, that would be huge. Their ability to scale production, secure supply chains, and also manage logistical challenges will be key in achieving these targets. SuperMicro stock has been on a roller coaster ride. On the 3rd of February, it closed at $26.85, while just 2 weeks later, on the 19th, it traded at $66.44 at some point during the day, and then it closed at around $60. These massive swings suggest that short covering was driving volatility. But beyond technical movements, what is driving the bullish and the bearish cases? The bulls point to strong investments in AI data centers and a deep partnership with NVIDIA, while the bears highlight increased competition, margin pressure, and historical volatility. There's a lot happening behind the scenes as well. It was hinted in the earnings call that there is a confidential product in development. Liquid cooling adoption is expected to reach 30%, which is a major tailwind as data centers move toward energy-efficient cooling solutions. Then you have the partnership between SuperMicro and NVIDIA, which remains strong, and this could help SuperMicro to win additional contracts. And then there was also an announcement about the new 3 million square foot campus in San Jose, which will help to increase its US manufacturing capacity. Currently, they can deliver around 5,000 air-cooled and around 2,000 liquid-cooled racks per month. They also have significant spare capacity. For example, the Malaysia plant is only 1% utilized, while the US sites were only running at a 70% capacity. One of the most interesting aspects, though, is the potential margin expansion. They are still targeting a gross margin of between 14 and 17%, which they achieved in the past, but it came down significantly over the last couple of quarters. And while I don't think that will happen in Q4 or even in Q1, but they might get there around the September quarter. However, there are also risks to consider. Tougher competition from both Dell and Cisco, which are aggressively expanding their AI server businesses. Then there's margin pressure, as they transition from Hopper to the Blackwell architecture, which may also need additional R&D spending. Then there's the need for additional working capital to support their growth. Expanding this fast requires capital, and potential share dilution or debt issuance could weigh on the stock. They also have admitted in their 10K that the internal controls are weak, so they are upgrading their IT systems. And this could lead to a tighter financial oversight, reducing operational risks in the long run. Then you also have the DeepSeek effect. If models are introduced which need less computing power, then there is going to be potentially less infrastructure spending. However, that could also have a positive effect by broadening the use case and applications as well, and therefore the total addressable market would grow significantly. Another concern raised in the media is that Charles Liang's wife and also other key employees sold a significant amount of stock. And while it is true that Mrs. Liang sold, I think, 46,000 shares, the Liang family still indirectly owns more than 67 million SuperMicro shares. So this isn't as concerning as some headlines suggest. Due to the filing delays, some analysts have suspended the coverage of the stock, but after the company filed its delayed 10K and also the 10Qs, they have reinstated coverage. Let's now have a look at what the analysts are saying. Loop Capital on the 26th of February increased its price target from $50 to $70. Then on the 27th of February, Barclays reinstated its coverage with a price target of $59. On the same day, Goldman Sachs increased its price target from $36 to $40. And then on the 28th of February, Mizuho reinstated its coverage and also increased its price target from $45 to $50. And then lastly, on the 6th of March, Northland increased its price target from $57 to $70. Most of the analysts assume $35 billion in revenue for fiscal year 2026 in their models, which is significantly below the company's own $40 billion plus projection. And even Northland, who raised the price target to $70, calculate with a 2026 revenue of only $30.9 billion. If SuperMicro delivers on its higher revenue guidance and increases its margins, then these targets could be conservative. If SuperMicro delivers on its higher revenue guidance and increases its margins, then these targets could be conservative. Historically, the company has traded at a P multiple of around 20, but some analysts are using a multiple of 13, similar to what they are using for Dell as well. During the earnings call, one of the analysts asked if they were right to assume that Q1 and Q2 revenue in 2026 will come in at around 8 billion and that Q3 and Q4 revenue at around 12 billion each, so that they would get to the 40 billion number. And Charles Liang didn't confirm or deny the numbers, which leaves room for speculation. The key question is, can SuperMicro execute on its 60% plus revenue growth for both 2026 and 2027, while also delivering on a gross margin of between 14 and 17%? If they can, there is upside in the stock. But the skepticism in the market suggests that many don't believe that they will. SuperMicro is in a golden opportunity phase, but also high risk, high reward setup. It has a relatively low market cap, a potential short squeeze scenario, and extreme volatility. If you are considering a position, dollar cost averaging on a monthly basis could help to manage your risk. And if there is a major market dislocation, it could be a chance to increase your exposure. But as always, do your own due diligence before making any investment decisions. What do you think? Can SuperMicro deliver on its bold revenue targets? Drop your thoughts in the comments below. Thanks for watching, and don't forget to like, subscribe and watch another video. See you in the next one. Thank you. Bye.